Welcome back, everyone, to The Explainer. Today, we're diving into a topic that honestly touches almost every professional out there: decoding non-regular payments. Let's get right into it. So you ever look at your pay stub after landing a massive, hard-won $5,000 bonus, only to feel that absolute shock when you see what actually hits your bank account? It's like, why doesn't $5,000 ever actually equal $5,000? We've all been there. Today, we're going to demystify exactly why that happens and look under the hood at how the math actually works. Here's our roadmap for The Explainer today. We're covering 1. The non-regular pay problem. 2. The big 3 employment payments. 3. Payments outside employment relationships. 4. Navigating statutory deductions. And finally, 5. Special income tax methods. Starting with Section 1, the non-regular pay problem. Okay, so here's the aha moment. Standard tax tables are built on a really basic assumption. They estimate your annual income by taking whatever you earned in your current pay period and multiplying it by your pay frequency. So if you suddenly get a lump sum bonus, standard math totally fails. It artificially inflates your estimated annual income, bumping you into a way higher tax bracket just for that one single paycheck, which is exactly why we absolutely need specialized tax calculation methods. Moving to Section 2, the big 3 employment payments. So, the big 3 non-regular employment payments are retroactive earnings, bonus and incentive pay, and vacation pay where no actual vacation time is taken. Now, because these are paid within an employment relationship, they're classified as employment income, and that means one thing: they immediately trigger statutory deductions. Let's break down the first of the 3 retroactive types. A retroactive adjustment is basically just an administrative catch-up. It happens when an authorized wage increase is awarded, but the paperwork is, a bit late getting to the payroll department, so the pay just has to be adjusted after the fact. Now, contrast that adjustment with a retroactive increase. This happens when a wage increase is awarded, but the effective date is completely backdated. A classic example here is when union contract negotiations stretch months past the old contract's expiry date. Once it's finally signed, those new wages apply retroactively. Our final retroactive type is the reinstatement payment. This is back pay ordered by a court or a union when a terminated employee gets reinstated to their position. Legal decisions basically force the employer to make the employee whole for the wages they lost during that whole period. Next up, Section 3, payments outside employment relationships. The key distinction here is the source. Employment income, like your bonuses and retro pay, is tied directly to being an employee. Non-employment income, things like director's fees and death benefits, happens entirely outside that standard relationship. Because of that, non-employment income requires a totally different set of prescribed withholding rules from the government. Let's look at some critical exceptions for director's fees. These are fees paid to people serving on a board of directors. For compliance, you do not withhold Canada Pension Plan contributions if the director is 70 or older. You also skip CPP if they're 65 to 69, already receiving a pension, and they've officially filed the CPT 30 form. And finally, no employment insurance premiums are withheld for directors in the private sector. Then we have death benefits. These are discretionary payments made by an employer to the estate or beneficiary of a deceased employee. The big rule here hinges on a $10,000 threshold. The first $10,000 of a discretionary death benefit is completely exempt from income tax. You only start calculating taxes on the amount that exceeds that specific number. Section 4, navigating statutory deductions. When we map these payment types to the correct deductions, you can see retroactive pay and bonuses get hit with basically everything: pension, employment insurance, the Quebec Parental Insurance Plan if applicable, and the 2% Northwest Territories and none of it payroll tax. Directors' fees get hit with most of these, but remember, no EI in the private sector. And look right at the bottom. Death benefits are uniquely exempt from absolutely everything across the board. They are only subject to income tax. Section 5, special income tax methods. Now for the mathematical cheat codes the government gives us to solve that standard tax table problem we talked about earlier. First is the retroactive tax method. This method brilliantly prorates the retroactive increase over the lapsed pay periods since the increase was effective. This is super important because it protects the employee. It stops them from being massively overtaxed just because their raise was paid late as a giant lump sum. It figures out the exact tax difference as if they'd been paid correctly the whole time. Next is the bonus tax method. The whole point of this method is simple. It prevents overtaxation on irregular payments, like your annual bonus or a payout of unused vacation time. Let's see how this actually works. Don't worry, it's a logical recipe, not advanced calculus. Step 1, divide the bonus by your pay period frequency, like 26 for biweekly. Step 2, add that little slice to your regular pay. Step 3, find the tax on that combined amount. Step 4, subtract your normal tax, which leaves just the tax on the bonus slice. Finally, step 5, multiply that tax difference back by your pay period frequency. It perfectly smooths out the tax burden. But watch out for this compliance trap. If a bonus is paid on a totally separate check from regular pay, the manual calculation method says you have to skip the CPP pay period exemption. You can only use that exemption once per pay period. If you apply it twice, you're absolutely going to end up under withholding. Finally, we use the lump sum tax method for non-employment payments, like the taxable chunk of a death benefit after that $10,000 exemption. Outside of Quebec, it's super straightforward. 10% for amounts up to $5,000, 20% for amounts between $5,001 up to $15,000, and 30% for anything over $15,000. Just keep in mind that Quebec uses a split federal and provincial grid instead of this combined rate. So, I'll leave you with this to think about. Are your company's bonuses inadvertently pushing your employees into the wrong tax bracket just because you're using standard tables instead of the prescribed bonus tax method? Mastering these non-regular payments gives you the tools to audit your methods, protect your employees' paychecks, and really nail payroll compliance. Thanks for joining me today on The Explainer.